Hi everybody, this is Ellman, the Blue Collar Investor, with today's covered call writing question of the day. Today's question comes from Praveen. Hello Alan, I have a question for you with regard to a Black Swan event type hedge. What in your opinion are some of the better ETFs, leveraged or not, to hedge against a dramatic downturn? I think the market has run up too quickly and is due for a major pullback. I've looked at leaps, put leaps, but the at-the-money puts are quite pricey. Knowing that an at-the-money put is going to be expensive regardless, there must be some that are better priced than others. Looking forward to your thoughts. Please keep up the great work. Well, thanks, Praveen. For those viewers not familiar with some of the terms used in Praveen's question, let me briefly go over those. First of all, SPY is an exchange-traded fund that reflects the S&P 500 index. A Black Swan event is an unusual, unpredictable event that can impact the stock market. In Praveen's question, it would negatively impact the stock market. A leaps option is a long-term option, usually longer than 1 year. And finally, a put option gives the buyer the right to sell his stock at a specified price. So let's give a hypothetical example here. Let's say you bought a stock at 38 and sold the $40 call option for $2. Then you purchased the $35 put option for $1. Well, your net credit then would be $1, 2 minus 1. So it's cutting your profit in half. However, should the price of the stock drop from 38 below 35, you still have that right to sell at 35. So it will give you the protection of catastrophic loss should the price of the stock drop dramatically below the $35 put strike price. Okay, so that being said, let's take a look at some of the choices we have if our overall market assessment is bearish. As you can see on the screenshot in front of you, the first one is the one that Praveen is suggesting, where you buy a protective put. Now, as I said before, the disadvantage is that you are going to be eating away at your covered call writing profits. And the advantage is it will give you protection against catastrophic loss. That's one way of doing it. Now, the others are in all of my material, and the first one is you could sell an in-the-money call option. So if we go back to that example again, you buy a stock for 38, and instead of selling the $40 out of the money call option, you sell the $35 in the money call option, let's say for $5. Well, of that $5, $3 is intrinsic value, not profit, because the strike price is $3 less than the current market value. The remaining $2 is your profit. So in essence, when you sell an in-the-money strike, the intrinsic value is protecting the time value, because the $2 in time value is protected as long as the price of the stock stays above $35. So that insurance of the in-the-money strike is paid for actually by the option buyer, the call option buyer, not by us. If we bought a put option, that would be a debit on our account. You can also use low beta stocks. They tend to outperform in bear markets. And in our premium stock reports, we list the betas of all the stocks that have passed our screens. In addition to that, you can use exchange-traded funds, ETFs, which generally have less implied volatility than individual stocks because they're a basket of stocks. Some go up, some go down. So the total volatility of the security is usually less than that of an individual stock. So if the market's going down, the ETFs will tend to go down less. You could sell out of the money cash secured puts. Example would be the current market value of the stock is 38. You sell the out of the money $35 put. Now, when you sell that, you're generating a profit from the put option. That cash is generated into your account just like when you sell a covered call. Now, that option will not be exercised unless the price of the stock drops from 38 below 35. So if that happens, your cost basis is then 35 minus the premium you generated from selling the put. So you would enter that position at a much lower cost basis than you had you purchased the shares for $38. It's a more bearish strategy, but one that can be employed in bear market environments. And finally, you could write covered calls on inverse exchange traded funds. And we always list the 4 inverse ETFs in our premium ETF report every week for our premium members. And those are based on broad market indexes. And those inverse ETFs will go up in value if the market itself goes down in value. And many of them have options associated with them. So if you're in a true bear market, you could thrive making money selling covered calls on inverse ETFs. Again, this material is detailed in my books and DVDs. So those are the choices that you have. I'd like to next turn to a put options chain on SPY, Praveen, because that's the one you asked about, and I feel that's an appropriate one if you're going to hedge a total portfolio. So here we're looking at the put options chain for SPY, and you asked about LEAP, so we're going to go to January 2015, and this video was produced at the end of 2013, in November of that year, and at the time SPY was trading at 176.21. So we're going to look for the near the money. It's not exactly at the money, but near the money 175 strike. And if you take a look at that, you could see that that would cost to purchase $13.73. That gives us the right to sell SPY at 175. So if it drops way below that, we could still sell it at 175. But it's going to cost us $1,373 per contract. You're right, it is pricey. That information is in the yellow highlighted row. Now, one thing you could do to decrease your cost is to use an out-of-the-money put instead of an at-the-money or a near-the-money put. And those are highlighted in the pink column. And you could see if you drop down to the 155, for example, that's at 679, so you're cutting your cost in half, but you're not getting nearly as much protection. So you have to decide how much catastrophic protection are you willing to pay for. For an at-the-money or near-the-money put means you're really willing to take almost no risk, but it's going to cost you. So you have to decide how much risk you're willing to take and how much you're willing to pay for that put option. Another advantage, by the way, if you're taking a look at this options chain of the SPY, it's such a liquid ETF. In other words, there's so much interest in it, so many trades being made by it, that the bid-ask spreads are relatively favorable compared to other exchange-traded funds. So that would be another advantage of using SPY to hedge your portfolio. Okay, let's move on. Let's talk about the advantages and the disadvantages of using SPY put leaps as protective puts. The advantages, well, they do mirror a well-balanced portfolio. Number 2, they're highly liquid. Lots of contracts being traded, a lot of open interest, a lot of daily volume. That results in very favorable bid-ask spreads as compared to other ETFs. And it does protect you against catastrophic market decline, which seems to be, Praveen, your major concern right now. Disadvantages of leaps as protective puts in general, not specifically in this case, is it will significantly decrease your covered call writing returns. There's no doubt about it. You have to be willing to accept lower returns if you're buying insurance. You're also taking a long-term bearish position in a market that historically goes up in value. Leaps is a long-term obligation, and you're purchasing over a year on a put. If the market goes up, that put value will go down. Small to moderate price declines can be managed for free by using the exit strategies that's detailed in my books and DVDs. I've written an entire book on this subject, and I've devoted over 50 pages in my third book, The Complete Encyclopedia for Covered Call Writing. And those management techniques are free. So if you just get these moderate or small price declines, you really don't need protective puts. And finally, you can also manage moderate to small declines by the type of covered call trade that you execute. We talked about executing in the money strikes, where the intrinsic value protects the time value. That will help in small to moderate price declines. You won't need to purchase protective puts. You could use inverse ETFs if you're in a bear market condition. The market's going down, but your underlying security is going up in value, and you're selling calls on top of that. You could use low beta stocks. Those tend to outperform in bear market conditions. And generally speaking, you could use exchange-traded funds that have less implied volatility than individual stocks. So there's a lot of ways to manage bear market situations. Protective puts certainly are one of them, but you have to be willing to give up some of those covered call writing profits. One size doesn't fit all. There's a lot of ways of handling it. So Praveen, thanks for that question. It's a great question. It's an important question, so I appreciate it. And thanks to everybody out there for watching this video. I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.